Imagine it's 2012. You're 22 years old. Your name is Sarah, and you're sitting at a folding table in a one-bedroom apartment in Columbus, Ohio. The furniture is cheap because you're still in that phase of life where everything is temporary. Temporary couch, temporary job hunt, temporary confidence. You graduated 3 months ago with a communications degree from a state university. Your guidance counselor called it smart. Your parents called it practical. And your parents co-signed. The loan's not because they understood the paperwork, but because that's what parents do when the country hands them a ritual and says, "This is how your child becomes an adult." You did your part. You studied. You walked across the stage. You took the photos. You applied to 47 jobs in 4 months. You got one call back. It was an unpaid internship at a marketing firm downtown. They told you it could lead to something. They didn't say what. They didn't say when. They didn't say how you were supposed to eat in the meantime. On your table is a stack of envelopes. Most are junk. One isn't. It's from your loan servicer. The language is polite, bureaucratic, almost kind like a hospital bill that pretends to be a greeting card. It tells you your first monthly payment is due in 14 days. $412. Your grace period has ended. You open your banking app. Your checking account has $69 in it. Is $550. You do the math. It takes 4 seconds. You can pay the loan or you can pay rent. You cannot do both. And in that moment, a strange new feeling hits you. Not panic, not even fear, but something colder. Recognition. You realize the blueprint you were handed had a trapdoor built into it. Go to college. Get a degree. Get a good job. Build a life. Nobody mentioned the degree would cost 4 times what it cost your parents. Nobody mentioned the job market would treat your credential like a minimum entry ticket, not a guarantee. Nobody mentioned that the debt would follow you through recessions, layoffs, medical emergencies, and career changes like a shadow that never sleeps. And nobody mentioned the most important detail, the one detail that makes student loan debt structurally different from almost every other form of debt in the American financial system. You can't erase it. Not in bankruptcy, not in hardship. Not in a clean reset the way capitalism usually allows failure to be cleaned up. This is not normal debt. This is debt with a locked door. And as you sit at that folding table, you begin to understand something no commencement speech ever prepared you for. The system was not designed for your benefit. It was designed to move money. You were the conduit. This is the story of American student loan debt, but not the simplified story you see on cable news. Not the story reduced into cultural warfare about lazy kids, entitled graduates, or whether a certain major was worth it. Those arguments are comfortable because they keep the problem small. They make it about personality. They make it about morality. And morality is a wonderful distraction from mechanism. Because the real story is a financial machine engineered over 6 decades, expanded through bipartisan consensus, protected by legal structures that exist nowhere else in consumer finance, and now holding roughly $1.77 trillion in outstanding debt spread across about 45 million borrowers. That's 1 in every 7 Americans. And the machine that created it has no off switch. This is not opinion. It is policy history, legislative architecture, accounting reality. And once you see how the machine was built, you cannot look at the American economy the same way again. Most people think student debt is about individual choices. A person chose an expensive school. A person chose an impractical major. A person didn't work hard enough after graduation. This framing is politically convenient because it places all the weight on the borrower and none on the structure. It's the same framing used in 2007 when homeowners were blamed for taking subprime mortgages while the banks that designed, sold, and securitized those mortgages sat behind the curtain, protected by complexity. The framing is a shield. It protects the architecture. Here's what is actually happening. The United States federal government runs the largest consumer lending operation in the country. Not guarantees, direct lending. Since 2010, after reforms eliminated the old structure where private lenders originated many loans under federal guarantee, the federal government has increasingly become both the lender and the debt collector. The Department of Education holds an enormous loan portfolio, loan assets so large they rival the GDP of major nations. Pause and appreciate what that means. A sovereign government whose purpose is governance is operating a consumer lending portfolio larger than most countries' entire economies. And the borrowers in that portfolio are disproportionately young people aged 18 to 24 who sign loan documents before they have a credit history, before they have stable income, and often before they understand compound interest the way they will understand it later when it starts eating their lives. There is no other loan product in America where a lender would routinely extend 5 or 6 figures of unsecured credit to someone with no income, no assets, and no credit history. None. If you walked into a bank at 18 and asked for a $60,000 unsecured personal loan to start a business, you would be laughed out of the building. But if you said it was for tuition, the money would appear, because the government stands behind it, because the lender bears almost no risk, and because the debt this is the core cannot easily be discharged. That is the engine. That is the mechanism that pushes everything else. When a lender is protected from failure, lending expands. When lending expands without discipline, prices rise. When prices rise, borrowers borrow more, and the machine grows. To understand why this became so powerful, we have to go back not to culture, not to personal choices, but to history, to Sputnik, to the Cold War, to the moment America decided education wasn't just personal improvement, it was national defense. In the next section, we'll trace the origin story from 1958 onward, how good intentions became permanent policy, how federal money flooded into universities, why tuition exploded, and how the system began to function like a one-way transfer of wealth, from young borrowers to institutions with no risk. Because once you understand the origin, you start recognizing the pattern. And the pattern is always the same. When you remove market discipline from a transaction, someone will capture the subsidy, and it usually isn't the person you were trying to help. To understand why student debt feels like a time bomb now, you have to understand how it began. Not in a boardroom, not in a conspiracy. In Fear, 1958. The Soviet Union had just launched Sputnik, a silver dot in the sky that triggered something primal in the American psyche, panic that the future belonged to someone else. It wasn't just a satellite. It was a message, a proof of capability, a warning that science and technology were now instruments of power. America responded the way empires respond when they feel threatened. It mobilized. Congress passed the National Defense Education Act, creating the first federal student loan program. The purpose was narrow and strategic: fund students in mathematics, science, engineering, foreign languages fields considered critical to national defense. At first, the system was modest. Loans were smaller. The program was limited. The idea was simple. If we educate more engineers, we win the future. It was not designed to create a debt class. It was designed to create national capacity. Then came 1965. Lyndon Johnson's Great Society, the Higher Education Act. And this is where the relationship between the federal government and higher education shifted from strategic to structural. The law expanded grants. It expanded loans. It built the framework that would eventually funnel massive streams of federal money into colleges and universities across the country. The intention was noble, hard to argue with. It's almost sacred in American mythology. Higher education should not be reserved for the wealthy. A degree should be a pathway to the middle class. And for a while, it was. In the 1960s and 70s, a student could work a summer job and cover most of a year's tuition at a public university. The ratio of tuition to median income was manageable. The system still had something resembling equilibrium. But once federal money entered the system in volume, a second mechanism activated. A mechanism so predictable, it's almost embarrassing that it was treated as controversial. When you subsidize demand, prices rise. And in higher education, the subsidy came in the form of guaranteed borrowing capacity. In 1987, Secretary of Education William Bennett wrote an op-ed that became infamous. His argument was blunt. Federal financial aid doesn't simply help students. It allows colleges to raise tuition because they know the money is available. The schools capture the subsidy. Students don't pay less, they borrow more. This idea became known as the Bennett hypothesis. For decades, universities and political allies dismissed it as ideological, an attack on education. an attempt to shrink opportunity, a conservative talking point. But the numbers refused to stay quiet. Study after study began to observe the same pattern. Increases in federal aid correlate with tuition increases. Not 101, not mechanically identical across every context, but with a persistent pass-through effect that is too large to ignore. And the mechanism is not complicated. In a normal market, price is restrained by a buyer's ability to say no, to walk away, to choose alternatives, to negotiate. Higher education has slowly neutralized those forces. The price is the price. There is no negotiation, and the cultural pressure is immense. Not going to college is treated as opting out of adulthood itself. It's framed not as a rational alternative, but as failure. So when the federal government makes borrowed money abundant, universities face less discipline, not more. The buyer cannot resist, and the seller knows it. So tuition rises, then rises again, then rises again. Between 1980 and 2023, the cost of tuition and fees at a four-year public university rose roughly an order of magnitude, far outpacing inflation and outpacing median household income. It didn't just creep upward, sprinted ahead like a runaway train. This is the moment the college investment story begins to rot. Because if education gets dramatically more expensive relative to income, the return on that investment has to rise too, or else the transaction becomes what it truly is, a transfer. Now, if tuition increased that dramatically, you might assume the education itself got proportionally better. That classrooms improved, that faculty were paid like society's architects, that the core mission of teaching and intellectual development was massively upgraded. It wasn't. The uncomfortable truth is that a large share of cost growth did not go into teaching. It went into institutions, into the bureaucracy, into the brand, into the arms race of amenities that turned universities into luxury resorts with diplomas attached. Look at the campus landscape of the modern era: climbing walls, lazy rivers, state-of-the-art recreation centers, luxury dorms marketed like boutique hotels. Universities hired armies of administrators, associate deans, assistant provosts, directors of engagement, vice presidents of this and that, trolls that multiply in an ecosystem where growth is rewarded and accountability is diffuse. Meanwhile, the actual teaching, the thing students think they're paying for, is increasingly outsourced to adjunct instructors, people paid by the course, without benefits, without job security, sometimes earning wages so low they qualify as academic poverty. The university hires a vice president of wellness on a six-figure salary. The person teaching your introductory course makes a few $1,000s per class and has no health insurance. This is not an accident of capitalism. It is a consequence of a revenue model where the institution captures money upfront, regardless of outcomes. And here's where the story turns genuinely dark. In this system, the university bears almost no risk. The federal government lends the money. The student borrows the money. The university collects the money at enrollment. The student graduates and thrives. The university claims victory. If the student drops out at common outcome in a system that enrolls broadly, the university keeps the tuition anyway. The student keeps the debt. There is an old term for a business model where one party captures revenue and bears none of the downside. It is a very old term. It is called a racket. Now add one more layer and you begin to see why this system grew so fast. The federal government did not just expand lending. Over time, it expanded lending into a legal environment that protected the debt in ways no other consumer debt is protected. And this legal shield is the real reason student debt became uniquely dangerous. Because even a badly designed lending system can be corrected by default, by bankruptcy, by failure. But student loans were carved out of that escape hatch, step by step, over decades. In the next section, we'll open the legal architecture. How student loans became essentially non-dischargeable. Why undue hardship is almost impossible to prove. How this changed lending incentives forever. And why the borrower became the only participant in the system who cannot walk away. Because once you remove the exit, you create a class of debtors who can be harvested for decades. And that changes an economy. It changes a generation. It changes the meaning of opportunity itself. In a functioning capitalist system, failure is ugly, but it is essential. Bankruptcy exists for a reason. It is society admitting that sometimes the math breaks, that sometimes a person falls. and that the economy works better when people can reset rather than be permanently crushed. Bankruptcy is not cheating. It is a pressure valve. It prevents financial mistakes from becoming lifelong prison sentences. And that is exactly why student loans are different. Because student loans were engineered to live outside the normal laws of consumer finance. They are debt with a locked door. The story people tell is moral. You borrowed it, you owe it. But the real story is legal and structural. And once you understand the legal architecture, you understand why the machine became so aggressive. Because when the lender is protected from loss, the lender can lend without restraint. And when lending has no restraint, prices explode. This is how the system becomes a time bomb. The legal shift began quietly. In 1976, Congress passed the first restrictions limiting the discharge of student loans in bankruptcy. The public justification was a fear story. Young doctors and lawyers graduating, declaring bankruptcy immediately, wiping loans, then going on to earn high incomes. Whether this was happening at meaningful scale is debatable. What matters is that the perception was enough to change the law. At first, the restriction was narrow. Student loans couldn't be discharged unless a certain number of years had passed after repayment began. The window expanded. The restrictions tightened. Then in 1998, Congress removed the time limit entirely. Federal student loans became non-dischargeable in bankruptcy, except under one condition: undue hardship. This phrase sounds compassionate, sounds like a safety net. In practice, it became a trap. Because undue hardship was never clearly defined in statute. Courts developed standards. Many adopted something like the Brunner-Testan infamous three-pronged threshold that requires borrowers to prove they cannot maintain a minimal standard of living if forced to repay. Their financial hardship will likely persist for most of the repayment period, and they have made good faith efforts to repay. Read that again and feel what it means. You must prove you are poor now, and you will remain poor for decades. And you tried hard enough to escape. This is not a normal legal test. It's a psychological test, a poverty oath, a demand that you prove your future is hopeless, and that hope itself career growth, improving income becomes evidence against you. So in practice, the vast majority of borrowers cannot discharge student loans through bankruptcy. Not because they don't suffer, because the burden of proof is constructed to fail them. And then, in 2005, the architecture expanded. The Bankruptcy, Abuse, Prevention, and Consumer Protection Act extended similar protections to many private student loans as well, tightening the cage even further. Now compare that to every other form of consumer debt. Credit cards, dischargeable; medical debt, purgeable; personal loans, teachable. Even certain business debts and failed ventures can be reorganized. But student loans often signed at 18. Before the borrower understands the consequences are uniquely difficult to escape. This is not an oversight. It is not a glitch. It is deliberate design, and design creates incentives. Once student debt became effectively non-dischargeable, the risk shifted. In normal lending, risk forces discipline. A bank that lends to someone who can't repay takes a loss. Loss disciplines lending. But with student loans, the government tore the system, reduced the loss. The borrower cannot escape. So the lender can lend to someone with no income, no assets, no credit history, because the debt is collectible across decades. And that changes the entire market dynamic. It means universities can raise tuition with confidence. It means lenders can extend credit without hesitation. It means the borrower becomes the shock absorber. You start to see why the system resembles something older than modern finance. A class of people bound to debts that follow them regardless of circumstance. A class of people constrained in freedom because their future labor has already been pledged. Historically, societies have had names for this. In different eras: peonage, debt bondage, indentured servitude. The legal structure is not identical, but the economic function is hauntingly similar. A debtor class that cannot escape, whose choices are shaped by obligations that cannot be shed. Now, you might think, okay, but people still repay, right? Some do. Many struggle. And millions exist in a strange limbo where they pay and the balance still grows. This is where the next mechanical layer appears: negative amortization. Borrowers enter income-driven repayment plans. Payments are set based on income, not the balance. That sounds humane, but in many cases, the payment is too low to cover the interest. So the borrower pays, and the balance grows. They shovel snow in a blizzard. They run on a treadmill that accelerates. And then comes the final cruel twist. After 20 or 25 years, the remaining balance may be forgiven, but the forgiven amount can be treated like taxable income under certain rules, creating a tax bomb at the end of the tunnel. The borrower survives the debt only to face a bill that looks like a punishment for endurance. So the machine has multiple layers of inescapability: bankruptcy protections that lock the exit, repayment plans that can extend the debt across decades, and eventual forgiveness structures that can create new liabilities. Now zoom out. When you apply this structure across roughly 45 million borrowers, the downstream effects stop being personal tragedy and become macroeconomic force. Because debt doesn't just take money, it takes options. It delays milestones. It suppresses risk-taking. It changes an entire generation's behavior. And this is measurable. Homeownership declines among young adults are linked to higher debt burdens. Household formation slows. People delay marriage, delay children, delay moving out of their parents' homes. Not because they don't want responsibility, but because responsibility now comes with a monthly payment they didn't have in previous generations. Entrepreneurship suffers. You can't take the risk of starting a business when you have an obligation you cannot discharge. Retirement savings shrink. The compounding cost of delayed investing is brutal. 10 years lost in the market is not 10 years lost, it is a lifetime of diminished future wealth. This is why student debt is becoming an economic time bomb. Because it is not just a debt problem. It is a mobility problem. And when mobility declines in a consumer economy, the whole system slows. In the next section, we'll track the downstream economic consequences: housing, birth rates, entrepreneurship, retirement, and why this debt structure behaves like a silent brake on American dynamism, closer to a slow bleed than a sudden crash. And then we'll confront the real question policymakers fear: if there is no easy exit, how does this end? If you want to understand how student debt becomes an economic time bomb, stop thinking about it as a moral issue. Start thinking about it like a weight on a spring. A society's young adults are supposed to be compressed potential. They're supposed to form households, buy homes, start companies, move for better jobs, have children, take risks, build wealth, and power the next phase of growth. That's how a consumer economy renews itself. That's how the middle class reproduces. Student debt doesn't just take money from that process. It steals time. It forces a generation to delay the very milestones that make an economy feel alive. And the downstream effects aren't theoretical. They show up in data, in demographics, and in a strange psychological malaise that has settled over young adulthood in America. People are working harder than ever, yet feeling permanently behind. Homeownership. The equity engine stalls. In the American economic story, homeownership is not just a lifestyle choice. It's the primary wealth-building mechanism for the middle class. A mortgage is forced savings. Equity compounds. A home becomes a balance sheet foundation that gives families stability, borrowing power, and the feeling that the future belongs to them. Student loan debt interferes with that in two ways. First, it raises your debt-to-income ratio, making it harder to qualify for a mortgage. Second, it drains cash flow, reducing your ability to save for a down payment. So the typical young borrower is hit on both sides. They can't save enough to enter the market. And even if they do, lenders see them as too leveraged. Research and modeling from institutions like the Federal Reserve have repeatedly pointed to this dynamic. Additional student debt is associated with lower probabilities of homeownership in the years after graduation. And when millions delay homeownership, the consequences ripple outward. It reduces housing demand. It slows household formation. It reshapes neighborhoods. It changes who captures housing wealth. While young borrowers sit on the sidelines, others buy. In a country where real estate has been one of the most consistent wealth escalators, being pushed out of homeownership is not just an inconvenience. It is a generational transfer of opportunity. Family formation. The birth rate meets the budget. Now look at the quiet demographic shift hiding behind the debt. Birth rates among younger adults have declined over the past 2 decades. There are cultural factors. Yes, but there are also financial ones that cannot be ignored. Ask a borrower with $400 to $700 monthly student loan payments whether they want children. Many do, but wanting and affording are different universes. Having a child means daycare, healthcare, housing stability, emergency savings. It means committing to future costs when your present is already pledged to debt. So people delay. They wait for stability that arrives later, if it arrives at all. And when millions delay, the national birth rate doesn't just dip, structurally shifts. This is how economic systems age. Not because people stopped believing in family, but because the entry costs to adulthood became too steep. A debt system that extracts cash flow from the young is a system that risks shrinking its own future workforce. Debt consumes tomorrow twice, once through repayment and again through fewer births. Entrepreneurship, debt kills risk. America loves to mythologize entrepreneurship. The garage startup, the risk-taking founder. The idea that anyone can build something new, but entrepreneurship requires slack. It requires a runway money, time, risk tolerance. Student debt destroys slack. A borrower with a large monthly obligation cannot easily quit a job to start something uncertain. They can't afford months without income. They can't qualify for small business credit because their debt-to-income ratio already looks toxic. They become less resilient to failure. So the person who might have started a company takes the safe job instead. Multiply that across millions, and you don't just get fewer startups, you get fewer experiments, fewer innovations, a slower economy. This is why the debt burden matters beyond individual suffering. It suppresses the economy's ability to regenerate itself. Retirement. The compounding loss nobody sees now. Consider the most invisible damage. Retirement savings. A borrower paying hundreds per month is often not investing in a 401k or IRA early. They delay. They wait until they're stable. But compounding rewards time more than it rewards intensity. 10 years of missed contributions in your 20s is not a small delay, can translate into a vastly smaller retirement. Balance decades later. Student debt doesn't just consume present income. It steals future wealth. And when millions reach middle age with less retirement savings, the burden shifts again. Less consumer spending. More dependency. More pressure on public systems. This is how a private debt problem becomes a public economic drag. The broader effect. A generation financially immobilized. Put these together and you get a clear picture. Student debt creates a generation on hold. Not because they are lazy. Not because they are irresponsible. Because their cash flow is pledged before their adult life begins. That changes everything. It changes where people live. It changes when they marry. It changes whether they have children. It changes whether they can take risks. It changes the social contract, the implied promise that if you work hard and follow the rules, you will do better than your parents. When that promise breaks, societies don't collapse overnight. They erode, they stagnate. Trust declines, anger rises. Politics radicalize. People retreat into cynicism because the system feels rigged in a way that can't be personally outworked. And then, quietly, the economy becomes smaller than it could have been. This is why student debt is a time bomb. Not because it will explode in one dramatic default wave the way subprime mortgages did, but because it bleeds economic dynamism year after year. It's not a crash, it's anemia. Now we reach the most important part, the exit problem. Because every time policymakers confront this, they run into the same wall. There are only a few broad ways out. Forgive the debt. Reform the system that creates the debt. Let the debt slowly default through income-based plans and hidden losses. And each option has consequences so severe that it becomes politically paralyzing. This is why the machine keeps running. Not because everyone loves it, but because stopping it forces someone to take the loss. And the system was designed from the beginning to ensure the loss never lands on the institution first. It lands on the borrower. In the next section, we'll confront the endgame. Forgiveness versus reform versus slow default. Why none are clean, and the one hidden financial constituency that benefits from the current architecture student loan asset-backed securities. The safe investment built on the fact that borrowers can't escape, because once debt becomes an asset class, a lot of powerful people start rooting for the debt to survive longer than the debtor. At the center of this crisis is a fact no politician wants to say out loud. There is no clean exit. Not because solutions don't exist, but because every solution requires someone to absorb the loss. And the student loan system was designed over decades to make sure the loss doesn't land on the institution first. It lands on the borrower. That's the difference between a policy problem and a structural trap. So let's talk about the three main endgame paths and why each one is politically radioactive. Option 1. Mass forgiveness, the fiscal explosion, and the moral hazard. Debt cancellation is the emotionally satisfying solution. It's clean, it's cinematic. It feels like justice. Wipe the slate, free the generation, restart the economy. But in federal accounting terms, student loans sit on the government's books as assets. Cancellation converts that asset into a loss, and the scale is not small. We are talking about debt measured in trillions. Canceling a massive portion of it is not just helping borrowers. It changes the federal balance sheet and adds to the national debt footprint in a way that competes with other gigantic budget priorities. Then comes the second problem: precedent. If you cancel the debt today without changing the machine that creates it, you are teaching tomorrow's borrowers and tomorrow's universities that borrowing is temporary and consequences are negotiable. The pipeline refills. Schools raise prices again because the political signal is clear. The government will eventually absorb the pain. Forgiveness without structural reform is not a cure. It's a painkiller. It makes the fever go down while the infection continues. Option 2. Reform the lending system. The political war. This is the option that actually fixes the machine, at least in theory. It means restricting how much the government lends. Means tying loan amounts to expected earnings. It means forcing universities to have skin in the game, sharing in losses when students default or fail. It means injecting market discipline back into tuition pricing. In other words, it means the institution finally bears some risk. And that is why it is so difficult. Universities are among the most organized, well-connected, and politically protected institutions in America. Higher education is not just a sector. It is a cultural pillar, a moral symbol. It wraps itself in the language of opportunity and enlightenment. Criticizing it is socially costly. And beyond symbolism, universities and education-adjacent industries lobby aggressively. They have money, influence, and deep networks in government. Reforms that threaten the flow of federal dollars into the system face immediate, coordinated resistance. There is also a political nightmare embedded here. Reform requires admitting that not every degree is financially worth its price at every school. That's true in data. But no politician wants to be the person who publicly says, "You can't borrow $120,000 for that outcome," because the moment you do, you are accused of limiting access, killing dreams, or punishing students. So the machine stays intact, because fighting the machine is a war. Option 3. The slow default, negative amortization, and deferred losses. This is the option nobody advertises, but it may be the one the system is drifting toward by inertia. Millions of borrowers enter income-driven repayment plans where payments are capped based on income. For some, that prevents immediate ruin. But for many, those payments don't cover interest. The balance grows. This is negative amortization, the same psychological horror that made certain pre-2008 mortgage products toxic. You pay faithfully, and the debt still expands. After 20 or 25 years, the remaining balance may be forgiven. The losses don't disappear. They are absorbed by the government over time. But because the costs are deferred across decades, it doesn't feel like a single budget explosion today. It's quiet, it's slow, it's bureaucratic, and it has a cruel final twist, depending on tax rules. Forgiven balances can become taxable income, creating a bill at the end of the tunnel and exit door that opens into another invoice. This is why the system can persist longer than people think. Because losses can be stretched, deferred, reclassified, and hidden in forecasts kept off the political front page. The debt doesn't end. It dissolves slowly into future budgets. That's the trap. Nobody wants to take the loss now, so everyone pushes it forward, and the eventual cost grows. The hidden constituency. When debt becomes an asset class. Now we add the layer most people never hear about because it makes the system feel less like policy and more like finance. Student loan asset-backed securities. slabs, loans bundled, sliced, and sold to investors tranche as created. Cash flows distributed, debt turned into a product. The concept is uncomfortably familiar because it mirrors the logic of mortgage-backed securities that fed the 2008 crisis. And here's the key selling point of SLABs. Student loans are safe because borrowers can't escape easily. Non-dischargeability increases expected cash flow stability that makes the debt attractive as an asset. So now, beyond universities and government balance sheets, there is a financial constituency that benefits from the legal architecture staying exactly as it is. Pension funds, insurance funds, institutional investors entities that care about predictable cash flow. In a twist that borders on parody, even some university endowments can have exposure to the debt ecosystem. So you get a machine where the university captures tuition up front. The government originates or supports the lending. The borrower carries the obligation. Investors profit from the cash flows. The legal system enforces the inability to escape. And the only participant without leverage is the borrower. This is not a conspiracy. It is a mechanism and interlocking set of incentives that produce an outcome no single person had to design consciously, because the system rewards everyone who keeps the pipeline open. The real question: what happens to a society that debts its young first? So let's end where the story really begins, back at Sarah's kitchen table. Because the most important question is not how large the debt number is. It's not whether forgiveness is fair. It's not whether some borrowers made poor choices. The real question is this: what happens to a society that converts its youngest, most productive citizens into debtors before they earn their first paycheck? History is not kind to societies that do that. When debt burdens concentrate on the young, the future shrinks. Household formation slows. Birth rates decline. Entrepreneurship declines. Social trust erodes. The political system becomes more volatile because the implied contract between generations breaks. Work hard, follow the rules, and your life will improve. The student loan crisis does not need to cause hyperinflation or currency collapse to do damage. Its damage is slower. Demographic, generational. A slow bleeding of dynamism from the world's largest consumer economy. And it compounds. Every year, the system runs unchanged. The debt grows, the affected population grows. And the cost of any eventual resolution grows. The question has never been whether the system is sustainable. The math answered that years ago. The question is how long a system can continue operating after sustainability has been lost. And history suggests the answer is always the same: longer than you think, and then all at once. If this kind of analysis matters to you, subscribe. Not for predictions, but for pattern recognition. Because most people don't see these mechanisms until the consequences reach their own kitchen table. By then, the machine has already been running for decades.